I need you to stop what you're doing, put down the coffee, close the other tabs, and look at the screen. Look at the price ticker on your phone right now. What does it say? If you're looking at the major Western feeds, the COMEX spot price, or the London fix, it likely says something around $71.47. Ladies and gentlemen, I'm Kevin Huang, and this is Markets in Context. If you are a technical analyst right now, you are probably drawing lines on a chart, looking at support levels, and telling yourself that the market is finally consolidating after a wild run. You're telling yourself that silver is holding the line. But I am here to tell you that the number on your screen is a lie. It is not just a little bit off. It is not just a lagging indicator. It is a hallucination. It is a ghost signal from a dying financial system that hasn't realized its heart has stopped beating yet. Because right now, while the screen tells you one story, the reality on the ground is screaming something entirely different. We are currently witnessing a historic structural dislocation. As of this weekend, Saturday, January 3rd, 2026, the mechanism of global price discovery for the white metal has effectively fractured along geopolitical lines. We have entered a world of price bifurcation, where the paper price in New York has completely decoupled from the physical reality in the East and the retail reality in the West. This isn't just a theory. It is a mathematical fact supported by every major exchange on the planet. While the COMEX March 2026 contract, ticker SIH26, settled on Friday at precisely $71.47 per troy ounce, physical silver in Shanghai is trading at premiums that would make a Wall Street banker's head spin. But here is the most important number you need to know today: 57%. According to the latest data, 57% of retail investors now expect silver to trade above $100 per ounce in 2026. Think about that for a second. More than half of the people actually buying the metal, the people moving their life savings out of a collapsing dollar and into hard assets, are betting on triple digits. And they aren't doing it out of blind hope. They are doing it because they can see what the institutions are trying to hide. They can see the banks scrambling to catch up, as their old world models are shredded by a physical deficit that cannot be resolved by printing more paper contracts. If you want to understand why the screen says 71 while the market says 100, you have to understand the liquidity flush that just took place. This past week, concluding on Friday, January 2nd, was a violent collision of two opposing forces. On one side, you have the regulatory intervention of the CME Group. On December 26th, 2025, the CME issued advisory number 25-393. This wasn't some routine update. This was an emergency margin hike designed to punish speculative leverage and force a sharp liquidation in Western futures markets. They raised the initial margin for a standard 5,000-ounce silver contract to $25,000. To put that in perspective, that same contract required only $9,000 in margins early in 2025. This was a calculated strike. It forced leveraged traders to either cough up massive amounts of cash instantly or dump their positions into a thin market during the holiday season. The result was what we are calling the Christmas crash, a forced liquidation that saw silver prices dip from the late December highs of $84 down to the current $71 range. But don't let the price drop fool you. This move by the CME was an act of desperation. It was a financial engineering trick designed to mask a physical shortage. Market veterans are already drawing parallels to the infamous Silver Rule 7 from January 1980, when the exchange abruptly changed the rules to break the Hunt brothers' attempt to corner the market. Back then, they forced liquidation-only trading to crash the price from $50 to $10. But 2026 is not 1980. In 1980, the world was awash in physical silver, and the squeeze was purely financial. Today, the situation is the exact opposite. We are facing a structural physical deficit, with COMEX inventories sitting at decade lows and global demand from the solar and AI sectors reaching an unrelenting vacuum state. By artificially suppressing the paper price through margin hikes, the CME has actually made the problem worse. They have created a massive arbitrage gap that is encouraging Asian buyers to drain Western vaults even faster, buying up physical silver at a discounted paper price that doesn't exist in the real world. If you're finding this level of context valuable, make sure you hit that subscribe button right now. We don't just look at the ticker here at Markets in Context, we look at the structural mechanics of the global shift. Subscribing ensures you're never caught off guard by the next ghost signal or margin trap. Let's talk about the performance of this asset because it puts the recent crash into a very different light. Even with the CME's intervention, silver was the best performing major asset class of 2025. It saw a staggering year-over-year appreciation of roughly 145%, moving from a 52-week low of $27.54 to that high of $82.67. The banks and the institutions are terrified of this momentum. They are watching silver move into what we call price discovery mode, where the old rules of gold to silver ratios no longer apply because the industrial demand is too high to ignore. Look at the technical setup as we head into this first full week of January. While the headlines scream about a crash, the Relative Strength Index, or RSI, tells a different story. The daily RSI has cooled from an extremely overbought level above 70 down to a neutral 47.07. This is exactly what you want to see if you're a bull. It means the froth and the speculative excess from the run to $84 has been successfully flushed out. The spring is now coiled and ready for the next leg up. The critical line in the sand right now is $69.70. As long as we stay above that support level, the long-term bullish structure remains perfectly intact. On the upside, we are watching $74.50 very closely. A close above that level on the COMEX would likely trigger a massive short covering rally and a run back toward the $80 highs. But even while New York traders bicker over these chart levels, the physical market is already in backwardation. This is a rare market condition where spot prices are higher than future prices. It is the ultimate signal of physical desperation. It means traders are willing to pay a premium right now for immediate delivery because they don't believe the metal will be available in the future. You have to ask yourself, why is this happening? Why is the world's most conductive element suddenly becoming the most contested asset on the planet? The answer lies in the fracture of global price discovery. We no longer have a single global silver price. We have a fragmented archipelago of regional prices, each reflecting local scarcity. In New York, you see $71 on a screen. But if you walk into a retail dealer like Appomattox or JM Bullion to buy a 2026 American Silver Eagle, you're not paying $71. You're paying upwards of $104.55. That is a 46% premium over the spot price. This massive divergence confirms what that 57% of retail investors already know. The paper price is largely irrelevant for the average person. Physical metal cannot be sourced at the screen price. We are seeing out-of-stock notices and shipping delays of up to 30 days at major bullion dealers. They are effectively selling silver they do not yet physically possess, engaging in a form of fractional reserve bullion banking to manage the lack of inventory. And while the West struggles with retail premiums and margin calls, the East has decided to take matters into its own hands. The true engine of this squeeze isn't coming from New York or London, it's coming from the East. We are seeing a transcontinental arbitrage gap of historic proportions, fueled by a geopolitical shift that most Western analysts are completely ignoring. The Shanghai premium is now oscillating between $2 and $10 per ounce over the COMEX price. This is the economic engine that is sucking available 1,000-ounce bars out of London and Swiss vaults and shipping them eastward at a record pace. But the pricing gap is only half the story. The real silver bomb dropped on January 1st, 2026, when the People's Republic of China officially activated its new export licensing regime. This move has fundamentally altered the liquidity profile of the entire global market, and it is the reason why the banks scrambling to catch up headline is more than just clickbait. It is a description of the current institutional panic. To understand where silver is going next, you have to understand the silicon shield that Beijing just built around its silver supply. Beijing didn't just wake up on New Year's Day and decide to tweak a few trade numbers. What happened on January 1st, 2026, was a fundamental rewiring of the global electrical grid. The Ministry of Commerce, or MOFCOM, effectively pulled the plug on the West's ability to source the most critical industrial metal of the 21st century. They have officially reclassified silver. It is no longer just a commodity to be traded on a free market. It is now a dual-use strategic material. They have placed silver under the same regulatory umbrella as tungsten and antimony. If you know anything about the history of trade wars, you know that when a nation classifies a metal as dual use, they are signaling that it is a weapon of statecraft. This is the birth of the silicon shield. While the United States and its allies have used semiconductor bans to try and slow down China's technological progress, China is now responding by restricting the very materials required to build the energy infrastructure that powers those chips. You cannot have an AI revolution, you cannot have a green energy transition, and you cannot have a modern military-industrial complex without silver. And as of 72 hours ago, the gate to that silver has been locked from the inside. I need you to understand the mechanism of this control because it is far more sophisticated than a simple ban. Beijing has implemented what they call a whitelist export regime. This isn't a rumor. It is a documented policy shift that has fundamentally altered the liquidity profile of the global market. For the 2026 to 2027 period, MOFCOM has authorized exactly 44 companies to export refined silver. That's it. In a country that produces more refined silver than almost anywhere else on Earth, only 44 entities have the legal right to move metal across the border. Think about the implications of that. This move locks out hundreds of smaller trading firms, independent refiners, and arbitrageurs who historically acted as the plumbing of the global silver market. These were the players who would see a price spike in New York and ship metal from China to capture the profit, effectively smoothing out global price disparities. By removing these players, China has effectively broken the global price leveling mechanism. They have created a closed-loop system where silver is trapped within the Chinese domestic market to feed their own voracious industrial sectors. And the barrier to entry for this whitelist is designed to ensure that only the state-controlled giants can play. To even be considered for an export license, a firm must demonstrate an annual production capacity of at least 80 tons of refined silver and possess verified credit lines exceeding $30 million. This ensures that every ounce of silver that leaves China is under the direct oversight of the state. We are talking about companies like Jiangxi Copper, the nation's largest copper producer and a massive producer of byproduct silver. We are talking about Zijin Mining, a global heavyweight that recently reported a 62% jump in net income driven by record metal prices. We are talking about Yunnan Tin Company, the world's largest tin producer and a key node in the silver refining network. By controlling these specific entities, Beijing controls the flow of newly mined and refined supply. They are keeping their domestic price suppressed to subsidize their own manufacturers, while the rest of the world is left to fight over the scraps. This is resource nationalism in its purest, most lethal form. Now, let's do the math that the mainstream media refuses to show you. To understand why the banks are scrambling to catch up, you have to look at the Shanghai Gold Exchange, or the SGE. While you were watching the COMEX in New York close at $71.47 on Friday, the physical market in Shanghai was telling a completely different story. The closing price on the SGE for the AG-T plus D physical contract was 17,059 RMB per kilogram. Let's break that down together because these numbers represent the true gravity of the silver market. 1 kilogram is equal to 32.1507 troy ounces. If we take that 17,059 RMB and divide it by the weight, we get a price of 530.59 RMB per ounce. Now, apply the prevailing exchange rate of approximately 7.2 USD to the CNY. That gives us a converted price of $73.69 per ounce. But that was just the close. During the peak of this week's volatility, the SGE price surged as high as 18,881 RMB per kilogram. Do that same math again. 18,881 divided by 32.15, then divided by 7.2. That gives you a physical price of $81.56 per ounce. Do you see the gap? While the paper contract in New York was being smashed down to $71 by margin calls, the actual physical metal in Shanghai was being bid up to over $81. That is a $10.09 premium per ounce. In the world of precious metals, a $10 premium isn't just a spread, it is an explosion. It is a total failure of the global logistical chain. It means that the Shanghai premium is currently oscillating at levels that make the COMEX look like a playground for paper shufflers, while the real business of the world is happening in the East. This persistent premium is the economic engine driving what we call the transcontinental squeeze. It is creating a massive vacuum. If you are an institutional holder of silver in a London or Swiss vault, and you see that you can sell your metal in Shanghai for $10 more than you can in New York, what do? You move the metal. You pull your bars out of the registered and eligible categories in Western vaults, and you put them on a plane to China to capture that arbitrage spread. This is why warehouse inventories at the Shanghai Futures Exchange have collapsed. They have fallen to roughly 715 tons, an 86% decline from their 2020 peaks. The Chinese fabricators aren't just buying silver, they are scrambling for it. They are vacuuming up every available ounce to ensure their factories don't go dark. And because of the new export regime, once that metal enters the Chinese domestic market, it isn't coming back. It's a one-way street. The Silicon Shield has turned China into a black hole for silver. This is the structural mechanic that the 57% of retail investors have already figured out. They understand that the paper price is a distraction. The banks, like JP Morgan and Goldman Sachs, are looking at their internal models and seeing a world of hedging and liquidity, but the retail market is looking at the Shanghai premium and seeing a world of scarcity and depletion. The situation is being exacerbated by the fact that Western mine supply is stagnant. Mexico and Peru, the traditional engines of silver production, are not seeing the investment needed to bridge this gap. This means that as China locks its gates, the Western markets are left relying on a dwindling pool of metal. This is the transcontinental squeeze in action. It is a slow-motion car crash, where the paper market is still trying to drive at 70 miles an hour while the physical road has been completely removed. I need you to remember that silver is the most conductive element on the periodic table. It is not something you can just swap out for copper or aluminum when the price gets too high, especially in the high-tech applications that China is currently dominating. This is why the reclassification to dual use is so terrifying. It signals that Beijing views silver as a component of national security. They are willing to break the global market to ensure their own technological sovereignty. If you're holding physical silver right now, you are holding the one asset that the world's largest manufacturing superpower is currently trying to hoard. You are holding the one asset that the Western central banks are trying to suppress through margin hikes. You are holding the one asset that is currently at the center of a geopolitical chess match between the COMEX and the SGE. The Shanghai Premium is the smoke, but the Silicon Shield is the fire. And as we move into the heart of 2026, that fire is only getting hotter. The banks scrambling to catch up isn't just a catchy headline. It is a description of an institutional class that realized too late that you cannot settle a physical shortage with a paper check. They are realizing that while they were playing with margin requirements, the East was playing for keeps. But if you think the pricing gap between New York and Shanghai is the only problem, you haven't seen anything yet. Because while the institutions battle over spreads and premiums, the world's most powerful industrial players are starting to panic. The Silicon Shield isn't just about trade policy. It's about the unrelenting vacuum of industrial demand that is currently eating the world's silver supply alive. When you have someone like Elon Musk tweeting, "This is not good," to his millions of followers, you know that the supply chain hasn't just bent, it has snapped. Elon Musk is not a silver bug. He is not a gold bug. He is a technologist who understands the periodic table better than most Wall Street analysts understand their own balance sheets. When he says, "This is not good," it's not a tweet about a bad quarter or a political spat. It is a warning to every manufacturer on the planet that the industrial blood of the modern world is clotting. Musk's concern reflects the absolute vulnerability of Western electric vehicle and solar manufacturers to the new supply constraints coming out of the East. You see, while the financial world is distracted by margin calls and paper liquidations, the industrial sector has entered what we call an unrelenting vacuum. This demand is what economists call price inelastic. If you're a solar panel manufacturer, you cannot simply decide to use less silver because the price went up $10. You can't swap it for copper without redesigning your entire production line and sacrificing the efficiency that makes your product viable. And right now, the photovoltaic industry is undergoing a technological shift that is absolutely disastrous for anyone betting against silver prices. And we are witnessing the solar singularity. The industry is transitioning from the old PERC technology to what is known as TOPCon tunnel oxide passivated contact cells. Here's the math that should terrify every silver short in the world. TOPCon cells are significantly more efficient at converting sunlight into electricity, but that efficiency comes at a heavy physical cost. These cells require 50% more silver paste per watt than the previous generation. And guess who is leading the charge in deploying this technology? China. They are aggressively scaling up TOPCon capacity to meet their massive renewable energy targets, and they are doing it while simultaneously locking the gates on their domestic silver supply. This is why the premiums on the Shanghai Gold Exchange are so explosive. Chinese manufacturers are bidding up the price of physical silver because their billion-dollar factories will literally stop running without it. They are choosing survival over profit margins, and in that environment, the paper price in New York is an irrelevant distraction. But it's not just about the sun, it's about the machines that are taking over our world. The explosion of artificial intelligence requires massive data centers packed with high-end chips and interconnects. Silver is the most conductive element on the periodic table, which makes it indispensable for signal integrity and high-performance computing. AI data centers rely on silver for the very circuits that power the algorithms. Then you have the electrification of transport. Electric vehicles use up to twice as much silver as traditional internal combustion engines. Despite attempts at thrifting or trying to use less metal, the sheer volume of EV production projected for 2026 ensures that demand will continue to outstrip supply. This is the vacuum. It is a fundamental repricing of a strategic asset that the world simply cannot function without. And while this industrial hunger is eating the global inventory, the physical supply chain in the West is showing signs of a total systemic breakdown. As of today, January 3rd, 2026, obtaining physical silver in any significant quantity is becoming nearly impossible for the average Western investor. The links have not just frayed, they are broken. Look at the sovereign level. The United States Mint is the world's largest producer of silver bullion coins, but they have effectively halted the immediate distribution of their flagship product. The 2026 American Silver Eagle 1-ounce proof coin has been delayed. The Mint's official schedule now shows the release date pushed back to January 20th, 2026. This isn't just an administrative delay. It is widely attributed to a plancher shortage. The mint simply cannot secure enough silver blanks, the planchets, at statutory prices to meet the demand. Under U.S. law, the mint must buy silver at market prices, but with physical premiums soaring and miners withholding supply, the sovereign producer is being squeezed out of its own market. When the United States government cannot find enough silver to strike a coin, you know the shortage is no longer a theory, it is a reality. And the retail market is reacting accordingly. What we're seeing from the major bullion dealers right now is unprecedented defensive positioning. Take Apimex, one of the largest online dealers in the world. They have issued disclaimers reserving the right to delay delivery by up to 30 days. Why? Because they have more buyers than sellers. This is a polite corporate way of telling you that they are selling metal they do not yet physically possess. They are engaging in a form of fractional reserve bullion banking, hoping that they can source the metal before your 30-day window expires. Look at JM Bullion. Key products like the 2026 Silver Eagle are listed as pre-sale, with shipping dates pushed deep into late January. The shelves are empty. This inability to source metal has driven premiums to record highs. While the COMEX screen tells you silver is $71, dealers are charging roughly $104.55 for a single Silver Eagle. That is a 46% markup. This suggests that the real equilibrium price, the price where a buyer and a seller actually agree to exchange metal for cash, is already over $100. The paper market is just a trailing indicator waiting to be dragged up by the gravity of physical scarcity. I want you to think about the psychological impact of this. When 57% of retail investors are betting on triple-digit silver and they see the U.S. Mint delaying production while dealers are charging $100 premiums, what do you think they do? They don't sell, they hunker down. They realize that they are holding something that is becoming more valuable every time a central bank tries to manipulate the paper price. This is why demand in places like India remains robust despite record high prices. On the MCX in India, silver recently breached the psychological barrier of 2.5 lakh rupees per kilogram. Instead of a collapse in demand, the market is witnessing a fear of missing out dynamic. In India, silver is being accumulated as a generational wealth preserve alongside gold. They understand that in a world of digital currency and paper manipulation, physical silver is the ultimate wealth shield. The divergence between the paper and physical markets is now so vast that the very concept of a spot price has become obsolete. We are operating in a fragmented landscape where silver is worth one price in a New York futures contract, another price in a Shanghai vault, and a completely different price at your local coin shop. This is the fracture in global price discovery, and as the banks scramble to catch up, they are finding that their old models of liquidity and managed volatility are completely useless in the face of a physical vacuum. The institutional players, who have spent decades shorting silver on the COMEX, are now looking at the Topcon solar revolution and the AI explosion, and realizing they are on the wrong side of history. They are watching the silicon shield lock them out of the most critical supply in the world. They are realizing that you can't pay for an AI chip with a silver futures contract. You need the metal. And the metal is gone. If you haven't subscribed to Markets in Context yet, this is the moment. We are tracking the most significant repricing of a strategic asset in our lifetime. Don't be the one left holding a paper contract when the world decides it only wants the physical reality. By subscribing, you get the context that the mainstream financial media is too afraid to give you. The pressure is building. The industrial sector is bidding up Shanghai. The retail sector is paying $100 premiums in the West. The U.S. Mint is out of stock. And the banks are finally beginning to admit that their models are broken. We are moving toward a confrontation where the paper shorts will be forced to cover at any price, and that any price is quickly looking like 3 digits. The question isn't whether silver will hit $100. The question is how much higher it goes once the technical breakout at $74.50 triggers the final desperate scramble for what's left of the world's supply. This isn't just a market movement. It is a fundamental shift in how the world values strategic resources. And as the consensus among financial institutions begins to flip from conservative caution to outright panic, the targets are being moved higher by the day. We are entering the era of the triple-digit repricing, and the institutions that once mocked the silver bugs are now the ones leading the charge into the bullish camp. The path forward is volatile, it is extreme, and it is point-blank, historical. The battle lines for 2026 are no longer being drawn in the sand. They are being drawn on the balance sheets of the world's most powerful financial institutions. As we look at the institutional forecast matrix, as of January 3rd, 2026, we see a consensus that has fundamentally fractured. The banks scrambling to catch up is not just a phrase, it is a visible panic in the data. For years, these institutions have treated silver as a secondary industrial byproduct, a poor man's gold that could be easily managed through paper positioning. But the 2026 price discovery mode has forced a violent repricing of their models. We are seeing a massive divergence between the old guard and the new reality. Look at the targets. Citi has officially moved to the head of the bullish camp, issuing a target of $110 for the second half of 2026. Their rationale? An acute physical shortage that has moved the market into a state of pure price discovery. They are effectively admitting that the supply-demand fundamentals have broken the traditional pricing mechanisms. Then you have Goldman Sachs. Their analysts are seeing gold at $4,900 and are positioning silver as the strategic green metal, with implied targets also breaching the $100 mark. Even Bank of America has moved their range up to $88, noting that if the gold to silver ratio compresses, as it historically does during a bull run, the upside could be significantly higher. But then, look at the other side of the ledger. You have JP Morgan and Saxo Bank still clinging to the $58 to $70 range. They are wary of volatility. They are looking at the recent Christmas crash and telling themselves the margin hikes will keep the lid on. This is the old guard betting that financial engineering can still beat physical reality. But here is what they are missing. Retail sentiment has already left them behind. 57% of traders now expect $100 plus silver in 2026. This isn't just optimism, it's a reflection of the FOMO, the fear of missing out, that is currently gripping the global market. This FOMO is nowhere more evident than in India. On the Multi-Commodity Exchange, or MCX, silver has already breached the psychological barrier of 2.5 lakh rupees per kilogram. Even with prices sitting at 237,732 rupees, the accumulation hasn't stopped. In the East, they aren't waiting for a bank report to tell them what silver is worth. They are watching the COMEX vaults drain and the Shanghai premiums explode, and they are buying silver as a generational wealth preserve. They recognize that in a world of accelerating inflation and geopolitical instability, silver isn't just a trade, it is a silicon shield for their personal net worth. Now, let's get into the weeds of the technical setup for the week of January 5th. At markets. In context, we use technicals to confirm what the fundamentals are already telling us. As the markets prepare to reopen on Monday, the technical indicators suggest that the recent correction, that 11% sink driven by the CME margin hike, has run its course. The Daily Relative Strength Index, or RSI, has cooled from an overbought state above 70 to a neutral 47.07. This is the Goldilocks zone for a breakout. It means the froth and the speculative leverage have been successfully flushed out by the Christmas crash, leaving a clean slate for the next move higher. The critical line in the sand for this week is $69.70. If the paper price on the COMEX were to break below that level, we could see a deeper washout towards $65 as stop losses are triggered. However, the market has already found incredibly strong buying interest near the 20-day moving average at $72.84. This tells us that the institutional buy-the-dip crowd is stepping in to defend these levels. On the upside, the target is clear, $74.50. A close above that level would be a massive signal to the algorithm-driven trading bots. It would signal the end of the consolidation and likely trigger a rapid run back toward the $84 highs and beyond. But what if you can't get physical metal? What if you're staring at a 30-day shipping delay at APMEX or a 46% premium on Silver Eagles? This is where we are seeing the rise of digital silver. In an environment where the physical supply chain is broken and futures are manipulated by margins, investors are turning to blockchain-based silver assets. Kinesis Silver, or KAG, is currently trading around $74.65. It tracks the physical price more closely than the COMEX futures because it reflects the underlying physical backing without the massive retail premiums of coins. Then you have Pax Gold, which serves as a liquidity gauge for the entire crypto metal sector. The stability of these tokens over the weekend, while traditional markets are closed, suggests that the demand for hard assets is now a 24/7 phenomenon that exists entirely outside the traditional banking system. As we conclude this analysis on January 3rd, 2026, the signal is unmistakable. We are in the year of the squeeze. The silver market is defined by a fundamental contradiction that cannot persist. The $71 price on your screen is increasingly detached from the $81 price in China and the $104 price in the retail shops. This confluence of China's silicon shield export controls, record industrial demand from the solar and AI sectors, and the structural deficit in Western vaults has created a perfect storm. The CME's margin hikes may have temporarily capped the futures price, but they have done nothing to alleviate the physical deficit. In fact, by suppressing the paper price, they have inadvertently accelerated the drain on Western vaults as arbitrageurs rush to buy silver at a paper discount to ship it to the physical reality of the East. For the professional investor, the message is clear. Volatility will be extreme. We are oscillating between deflationary financial liquidations and inflationary physical scarcity. But with inventories at historic lows and the world's largest producer, China, effectively locking its gates, the path of least resistance points one way, higher. The great silver squeeze of 2026 is not a speculative raid like 1980. It is a fundamental repricing of a strategic asset that the world simply cannot function without. It is the moment where the paper market finally yields to the physical reality. Whether you are looking at the city target of $110 or the retail bet on triple digits, the destination is the same. The ghost signal of $71 is fading, and the era of triple-digit silver is beginning. This has been Markets in Context. If you want to stay ahead of the Silicon Shield, the margin traps, and the global arbitrage, you need to be part of this community. Hit that subscribe button right now to ensure you get the context the banks don't want you to have. Watch the $74.50 level this week. Keep an eye on the Shanghai premiums. And remember, in a world of paper lies, the only truth is the metal you can hold. Thank you for watching, and I'll see you in the next one.